You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way. It's the 22nd of March 2025 and I'm joined by my co-host John McEwen. In this week's episode, we'll be discussing Persimmon, Dominos, Berkeley Group, Supermarket Income REIT, Legal and General, and we are breaking tradition this week because there were too many UK companies we wanted to cover. So instead of a US company, we have Deliveroo, which is another UK company.
A UK tech company, though, so it's more in the vein of some of those US tech stocks.
Yeah, a growth company. Our growth company of the week is Deliveroo. John, do you want to start us off with our first house builder of the week?
Yes, so it's Persimmon, which is the York-based house builder, and they had their full-year results out last week, with full-year revenue rising by 16% to £3.2 billion, which was driven by higher volumes as completions were up 7% to 10,664 new homes. Improving sales rates and average prices helped the order book climb by 27% to £1.15 billion. Underlying pre-tax profits grew by 10% to £395 million, ahead of market expectations. And this was helped by revenue uplift and a tight grip on costs. Free cash flow improved from an outflow of £165 million to an inflow of £57 million due to the increase in profitability. The net cash position fell from £407 to £244 million at the year end. The final dividend of 40p per share was announced, taking the full year total to 60p, and that was in line with the prior year. In 2025, completions are expected to rise to around 11 to 11,500 range, and the group is targeting further growth in profits and is comfortable with the current market forecasts, which point to pre-tax profit growth of around 13.5% to £432 million. And the shares were up nearly 3% in early trading. In terms of valuation, Persimmon has a market cap of £3.8 billion and trades at around 13 times earnings and 1 times forward price to book, compared to the 10-year average of nearly 2, and it has a prospective dividend yield of 5.6%. I thought these results were decent, largely as expected, but it looks like they're going into the new year in good shape. Demand is coming back. Interest rates steady at the moment, hopefully from Persimmon's point of view coming down further later this year. Really strong order book, and interesting in terms of, and we'll come on to this when we cover Berkeley Group, but where it operates in the market. So it's generally at the lower end, with their house prices being about 20% below the broader market. So in some ways, there is a bit more volume there compared with, for example, if you looked at what Redrow was before, or as we'll come on to later, Berkeley Group. I think the other thing that's worth mentioning about Persimmon is, yes, they did have some build quality issues a few years ago, but it does have an in-house materials business, which does help them keep their build cost inflation lower, and it's estimated to save them around £5,500 per plot. The other thing that you wonder about is if Labour are going to be relaxing the building and planning regs, how much that's going to benefit Persimmon. And as we always say with the house builders, that structural imbalance in the UK with a growing population and just not enough houses, and these big house builders largely being the solution or the perceived solution to that. So I think there's a lot going for it. I have Barratt Redrow, which I'm quite happy with, but I think I have owned Persimmon before, and I think it looks decent, and it's in, I think, a decent shape, probably at what I consider a fair valuation, at least historically too. So I think it's pretty attractive. Sam, what are your thoughts on these results and Persimmon?
Pretty similar. I think it's a very good year. I do think it's interesting what you picked up on in terms of the house builders at the lower end of the market seem to have had a cracking year, and then the ones at the higher end seem to have not had as much of a cracking year from the ones we've covered so far. I think you can do a lot worse. I think the valuation's fairly decent. I think it's got a lot of long-term tailwinds we've discussed. It's got a decent dividend yield. So yeah, I think it's had a good year. I think you can make a solid argument, but I'll probably save some of my other comments until we get onto Berkeley Group, because there will be a lot of overlap.
Great. Okay. How's Domino's UK doing?
So, Domino's I thought they were doing quite well, but I don't know if the share price thinks that. So, Domino's UK, they have come out with their full year results, and system sales were up 2% to 1.57 billion. Group revenue was down 0.4% to 664 million. Underlying EBITDA was up 6.4% to 143 million. Underlying profit before tax was up 8.4% to 107 million. Statutory profit after tax was down 21.6% to 90.2 million. However, that drop was due to the fact that last year's results included the profit on the disposal of the German associate. Underlying basic earnings per share was up 13.3% to 20p a share, and statutory was down 18% to 22.9p a share for the same reason we just mentioned. The full year dividend was up 4.8% to 11p a share. So in terms of the like-for-like system sales, they were up 0.7%, with improving performance in every quarter. And the fourth quarter was up 3%. Underlying EBITDA growth of 6.4% was driven by Shorecal and lower technology platform costs. So Shorecal is the largest Domino's pizza franchise operating in the Republic of Ireland and Northern Ireland, and they've acquired full control of it in a deal worth 90 million euros. They've highlighted the strong balance sheet with net debt of 265 million. The net debt to EBITDA ratio is 1.93, which is within the target range, down from 2.16 in the first half. For 2024 capital allocation, they've said that 82.5 million has been deployed in capex and investments, which include Shorecal and BP Poland. They've invested some money in basically the Polish Domino's, which operates 111 Domino's pizza stores and restaurants in Poland and a further 5 in Croatia. I find it a bit odd, the DP Poland investment, because they've just got out of Germany. They were historically in quite a few countries. They previously had operations in Switzerland, Iceland, Norway, and Sweden, but they closed those in 2019 due to poor performance, and they got rid of the German side last year for the same reason, and now they've immediately decided to go into Poland. So I do find that slightly odd. Whereas the previous strategy of concentrating on the UK and Republic of Ireland, I could get behind a lot more. They have highlighted that they've had returns via dividends and share buybacks of around 500 million since March 2021, and that actually represents about 50% of the market cap now, or just under, that's been returned to shareholders in the last 4 years. For the operational highlights, total orders were at 1.7%, delivery was up 2.4%, and collection up 0.5%. Average delivery time was down from 25 to 24.5 minutes. They opened 54 new stores across 21 different franchise partners with record Ireland store openings. They've got 9.5 million digital app customers, and the app now constitutes 76.3% of online orders, which is up 2.7%. And the average franchisee store EBITDA was 168k, which was up 6.6%, despite the 10% minimum wage increase in April. The Uber Eats rollout is completed, and that delivered incremental customers and orders. And they said that the Shorecal acquisition contributed 5.5 million to underlying EBITDA. They've also purchased an additional 24% of Victor DP Limited for 25.6 million, and that's the joint venture in Northern Ireland, which brings Domino's shareholding up to 70%. In terms of the valuation, the business trades at a PE ratio of 12.67 and has a yield of 3.79%. I think these are actually quite a decent set of results. I think Domino's has had a rough couple of years. I think firstly in terms of the app and stuff, it's doing very well on that side, the digital side. I think the moves to kind of buy the franchisees in Ireland, I think is a smart one. And I think that's a good way. Well, they can quite easily add quite a bit of value there because they don't have to pay the money to themselves. So they will just make higher margins. I find the Poland acquisition a bit odd, or the Poland investment a bit odd, but it's not a huge amount. So it's fine, but it just seems slightly pointless to me. In terms of the share price, it's had a bit of a roller coaster. So the 12-month high was £3.58 and 12-month low was £2.70. It's currently at £2.90. I think it's been as high as £4 in the past. It's touched £4 a couple of years ago. But I think you're getting a quality business, very entrenched position in the takeaway market. And I think to get it for, 13 times earnings and with a nearly a 4% dividend yield for such a high quality business. I know it's not the most glamorous, but I do think you can do a lot worse. And I really like it at this valuation. What about you, John?
I would certainly agree with you. Very high quality business, incredibly well run. I think the thing that I've wondered about Domino's in the UK is for some time now is just the prospect for further growth. I know it's not priced in, but it does feel very saturated. I guess you could make the argument for the Poland expansion, which I know you're not keen on, but where does that future growth come from? I suppose they are returning money to shareholders and probably the dominant player in the UK, but that's probably what would stop me from buying shares in Domino's.
So I think the strategy, and this is the first year I've seen this, I don't recall seeing much about it last year, but it seems the strategy has shifted a bit to just buying out the franchisees. And I don't think that's a terrible strategy because firstly, they've had quite a few relationship issues with the franchisees over the last few years, to put it mildly. So it solves that problem. It gives them an exit. It gives them increased EBITDA without having to really do anything. So they bought out the biggest one in Republic of Ireland. They now have 70% of the one in Northern Ireland. I would be very surprised if they weren't keen to take that up to 100% at some point. Whether they start buying out franchisees in the UK as well. I think if they do that, it's probably actually quite a low risk way of increasing the earnings and just buying high quality businesses that they know how to run very easily. I do view the Poland business as a bit more of a distraction, especially based on the track record. Now, if Poland and Croatia do really well, that's a nice bonus. But I just kind of view that money that's been invested as gone. Whereas I think continuing to buy out franchisees, I think is actually quite a smart strategy.
Fair enough. Okay, then. Shall we go to our second house builder?
Yes. How are Berkeley Group doing?
So Berkeley Group, or Berkeley Group, for anybody who doesn't know, is the builder that specialises in brownfield sites, building homes and neighbourhoods, and it's primarily across the south of England. They had their third quarter update out last week, with sales rates continuing to improve over the third quarter, now surpassing last year's level, and the group is hugely encouraged by the government's new mindset around planning reforms and house building ambitions. The full year net cash position is expected to fall from £474 million to around £300 million, partly due to increased share buybacks since the half year mark, and this was below the market forecast of £400 million. Pre-tax profit guidance of £525 million for the current year and at least £450 million next year remains unchanged. An interim dividend of 33 pence a share, so £33 million in total, will be paid on the 28th of March, and a further £156.1 million of cash will be returned to shareholders through dividends and share buybacks by the end of September 2025. And on this trading statement, the shares were broadly flat. In terms of valuation, Berkeley Group has a market cap of £3.6 billion and trades at 9.8 times earnings with a forward price to book of 1 compared with a 10-year average of 1.5, and it has a prospective dividend yield of 5.6%. I think this is, again, it was largely what was expected by the market. It does have a strong order book of £1.5 billion. I think the interesting thing, and one of the reasons for including it today, is that it's a nice contrast with Persimmon because it is much more a London focus. And the group had mentioned also that they were on track to deliver 4,000 new homes that are built and also some build to rent in London over the next 10 years. And their average sale prices are around £600,000, which if the market is going well and you're in that part of the cycle, you've got the higher margins. But the thing with Berkeley Group is that when it's doing the brownfield sites, yes, there are the higher margins with those big houses that it's building, and particularly in the south of England, but it's much more expensive to do it on the brownfield site compared with, I suppose, the very cheap cost of production for groups like Persimmon or potentially Taylor Wimpey is another example. My take on it, and I am biased, I have Barratt Redrow. I feel like with Barratt Redrow, you get a bit of both because you've got the Barratt and then you've got the Redrow, which is kind of at the higher end. So I think you're sort of placed in the middle of that market rather than skewed, one way to the extreme of Berkeley Group or to the other where you're sort of mostly northern with Persimmon and at that lower end of the market. So I wonder whether that's sort of a happy medium between the two. But overall, I think Berkeley Group's okay. I don't think it will be the one for me, but it is slightly different to those other house builders. And I think also that sort of some of those like build to rent, I think that's quite interesting in terms of strategy. but yeah, not the one for me, I don't think. Sam, what are your thoughts on this brief trading statement and Berkeley Group as a whole?
I don't think they've actually said a huge amount. I'm not sure what they've really put the statement out for. Maybe it's just maybe a bit of a nudge to the government, possibly, how hugely encouraged they are. But I think they are slightly differently positioned to probably Redrow, Barratt Redrow now, in that I guess Redrow's still, I guess it's at that higher end, but a lot of it's Midlands, and it's more like family homes. Whereas I think with these guys being basically purely southeast, they are at a much higher end of the market, and they are at an end of the market where house prices seem to be at such a level that most people just can't afford to buy them. And I think that's possibly reflected in the fact that they are doing build to rent. I think there's possibly a bit of a demand side issue there. And I am just speculating, but if Taylor Wimpey came out tomorrow and said they were doing build to rent, I'd kind of think, well, it's not really their bread and butter. They're not landlords. They build houses. That is what they do. And it's just a very different focus, I think, when it's just drawing attention away from what they should be doing, which to me, it does make me wonder, well, are management looking at it and thinking, well, we're going to struggle to continue to get the kind of returns we're used to, partly because of the amount the house price would need to increase from such a high level in the geographic area they're in. I'm just speculating, but I think it's interesting because it gives you exposure to probably a very different part of the market to all the others. If we were building a basket of house builders, like we've talked about previously, I think it'd probably go in there for that reason because it is a bit different. But I think I'd feel much more comfortable owning pretty much any of the others. So Persimmon, Taylor Wimpey, Barratt Redrow. I think I'd prefer any of those to Berkeley Group. But yes, it just concerns me that they're in such a high end of the market. And I don't know if I don't know how, again, I don't know the market as well, which doesn't help. I don't know how premium the houses are or if they are just that price because of the location. And it's basically just a Persimmon house. But
yeah. Yeah, it's a good question. I think it's, again, something in the middle. It's not that they're twice, for example, or three times the Persimmon house. I think they are at a higher end, but also that location adds a lot to the value.
Yeah, but it just concerns me with the buy to rent. If I want to go out and get exposure to that, the build to rent, I'll just go and buy a REIT. And there's a lot of very attractive REITs. I would never buy Taylor Wimpey and be like, you know what I'd really like? I'd like them to stop selling the homes and start renting them out. It's not, and it just ties up a lot of working capital as well, which for a house builder, you would think you'd want that kind of turnover. It fundamentally changes the business. And I don't know, one of the things we talk about with house builders is how much better capitalized they are compared to 2008. If you're sat on a load of properties that you've built and you're renting out, that massively changes your position. Because you're not turning over those properties and you're not releasing the working capital back out. It just ties up a lot of money, which I think would be a concern for me.
Yeah, I mean, it's interesting if you look at the share prices, and this is not including dividends, but Berkeley Group has performed much better than any of the other house builders.
So has that been on the back of kind of share prices, home prices in the southeast?
Well,
and how much of that is returns being pulled forward?
Yeah. I'm not offering any deeper in that. It's just a point of interest.
Right. Shall we move on but remain within the rental space?
Yes. So the exciting business that is Supermarket Income REIT.
Yes. So it is a business that I own, and they have come out with their interim results for the 6 months ended 31 December. For anyone who's not familiar, Supermarket Income REIT does what it says on the tins. They basically own a load of buildings that are let out exclusively at supermarkets. So think of like your big Tesco superstores, that kind of thing. That is the kind of buildings that they're letting out. So they come out with their 6 month results, and annualised passing rent was up 13% to 118.5 million. Adjusted earnings per share was up 3% to 3p a share. The statutory earnings per share was up 167% to 2.9p a share. Dividend per share was up 1% to 3.1p a share, and the dividend cover is 0.99, up from 0.97. That's pretty normal because it's a REIT, so it basically pays out all its earnings as dividends. Portfolio valuation was up 3% to 1.83 billion. The IFRS net asset value per share was flat at 90p per share. For reference, it's currently trading at 76.8p a share, which represents a 14% discount to the net asset value. Would caveat that for REITs, it's pretty normal for them to trade at a discount to net asset value. However, for this one, it's more unusual. It's historically traded at a premium due to the quality of the buildings and the rent collection. So the loan to value is now sitting at 39% compared to 37% a year ago. There's a capital recycling delivered through 63.5 million from the sale of Tesco Newmarket at a 7.4% premium to book value, highlighting the attractiveness of their assets and conservative valuation of the portfolio. So that's quite good if it's at a discount to NAV and they think it's actually a discount to what is quite a conservative valuation. And if they're able to recycle that portfolio at a premium to book value and you're buying it at a discount, that makes it even more attractive. They've completed 3 lease renewals at an average of 35% above the MSCI's supermarket benchmark index, providing valuable evidence of achievable rent renewals on high-performing, large-format, omni-channel stores at 4% rent to turnover. Earnings-enhancing acquisitions with 49.7 million in the UK and a further 36.7 million euros tranche of direct sale and leaseback with Carrefour in France. They've highlighted that the operating profit grew 12% to 50.3 million, which reflects a 13% increase in annualised passing rent to 118.5 million through acquisitions and contractual rental uplifts in the period. And the average annualised increase in rent from reviews performed during the period is 3%. 81% of rental income was inflation linked, and they've got strong performing investment grade tenant covenants with 79% of income from Sainsbury's, Tesco and Carrefour, and that's 79% as at 10th of March 2025. They acquired a Sainsbury's omni-channel supermarket in Huddersfield, West Yorkshire for 49.7 million, excluding acquisition costs, which reflects a net income yield of 7.6%. The post-period acquisition of 9 omni-channel Carrefour stores in France for 36.7 million, excluding acquisition costs, reflects a net initial yield of 6.8%. So it only IPO'd in July 2017. Since then, it's had 100% rent collection. From 2020 to 2023, revenue's grown at an average of 3.2% a year. Operating profits grown at 5.8%. Dividends grown at 1.13%, which isn't huge, but pretty reliable, and it's paying out basically all the earnings. I think to get this business at a 14% discount to net asset value, and currently the dividend yield is just under 8%, it's 7.91%. I know it's not particularly well covered, but it's a REIT, so you don't expect that. But when they've had 100% rent collection, they are continuously raising the rents. It's very high quality buildings, and a lot of them are buildings that are in population centres. So if they weren't able to renew one for whatever reason, it's likely another supermarket would probably be quite interested in it. But if not, I think they are buildings with a lot of optionality. They're the kind of buildings that can get turned into like food courts or potentially like a B&Q or flats or something else. There is a lot you can do with, because it's in population centres, that plot of land alone will give you a decent amount of protection. But when everyone's paid the rent, literally since 2017, that's not really a huge concern in any case. I think the net income yields they're able to get, even on the newer properties, I think they're making smart acquisitions like the Carrefour deal where it's just under 7%. I think these are very attractive returns considering how high quality the properties are. So as a shareholder, I'm very happy with these results, very happy with the dividend, and I will just be continuing to hold and collect my 8% dividend. John, what do you think of these results?
I think it's really interesting, and I think that yield very, very attractive, defensive, and you would expect, as you say, you've got a lot of protection there in hard times, or if you were to convert those sites into other use, there are a lot of options. So I like it a lot. It'd be something that I'd consider having in my own portfolio there for the income. But I suppose it's not the most exciting thing, and it's not a big growth industry, but yeah, very attractive from an income investment.
I don't think the dividend will stay at 8% because I think at some point, I think the share price will go up at some point and push that dividend down to probably around 6 or something. I think that's where I think if it's an 8% yield, you would expect a lower quality portfolio for that. And I know we've seen a few REITs where they are at these higher yields. I don't know if it's because they've been pushed down, because you can get 4 or 5% in a bank now or from REITs, and that's what's pushed it. But in terms of the quality of what you're getting for that 8%, if you look at that, if it were to stay at an 8% yield and you was to just recycle that dividend every year and just let it compound, you do incredibly well on what is a very high quality portfolio of buildings.
Yeah, no, absolutely. Absolutely.
Should we move on to Legal & General, another business with a very high dividend? I think it might be one of the highest on the FTSE.
Yeah, no, I think it is. So Legal & General, for anyone who doesn't know, it's in the financial services industry, specialising in pensions, insurance and asset management. They had their full year results out last week, reporting a 6% rise in core operating profit to £1.6 billion, which was in line with expectations. Performance was driven by the retail and institutional divisions, partly offset by declines in asset management. Pensions risk transfer, bulk annuity business, £10.7 billion. And there was also record volumes of the retail annuity business at £2.1 billion. Assets under management fell by 2% to 1.1 trillion as L&G shifted towards higher margin products. The Solvency II coverage ratio, a measure of the balance sheet strength, improved from 224 to 232% over the year. A final dividend of 15.36 pence per share was announced, taking the full year total to 21.36 pence, up 5%, and the board also approved a £500 million share buyback, in addition to the £1 billion share buyback already announced when the US protection business was sold, and the shares were down nearly 2% in early trading. I don't think there were any great surprises here in the L&G results. It seems like a very well-run business and fairly conservative, generating a lot of cash to shareholders with the annuities business at the centre of it. Obviously, the asset management side of things was slightly disappointing, and I guess it's a company that does have limited growth potential. And I thought it was good, though, that the new partnership in the US meant that they were able to offload that slightly faltering US protection business, which didn't really align with their core strategy. And I suppose headwinds-wise, there are a lot of market uncertainties, which I think is probably baked into the share price. And that, I wouldn't say it's depressed valuation, but it's certainly not asking very much at 10.5 times earnings. Very attractive dividend yield at nearly 9%. It does look like they've sustained that for a fair few years, and the business generating a lot of cash, which they don't have any real use for to grow the business, and are just, returning that to shareholders. I don't think it's a business that I would fully understand or feel like I'd have any competence to, I suppose, pick between L&G and some of its competitors. I had owned Prudential in the past, which I feel was more part of a legacy portfolio that I hadn't really been involved in selecting. But I think there could probably be a case if you were able to crack the business and you're more of an income investor, then, it certainly could be part of that portfolio. And as I say, its track record does seem to be fairly good over the last 5 years. Sam, what are your thoughts on L&G and these results?
The results are pretty decent. I do wonder if the IHT changes make it more attractive. So when you look at the annuity side of the business, so in 2023, annuity sales were up 50% compared to 2022, hitting a record level. And then by December 2024, they'd grown another 55%. And in terms of the market share, they've grown from 6.5% in 2016 to 20.2% of the annuity market. And we did talk about it around the time of the budget with the pensions coming into the scope of IHT. But does that potentially make annuities much more attractive? So could that be a bit of a tailwind for them? I think it possibly could. The issue, I think the dividend yield is very, very attractive, especially if the business is able to sustain it. I was trying to do a bit of digging and see why it's so attractive and how well covered it is. It seems pretty well covered, and there doesn't seem to be any sort of reason to suggest they're going to have to reduce it other than just general market uncertainty about the business. So it seemed like quite a well covered dividend, actually. The issue is, once you get into these Solvency II ratios and stuff, I get really uncomfortable in terms of that side of the business and actually assessing it. So for me, it looks like it could potentially be a good business, but it does just go in the too hard pile. But I think if you understand the business and you understand the dividend is quite well covered, it's just not quite the same, but it's kind of similar to what I was saying about supermarket income REIT. If you're just recycling that dividend every year and it's well covered, as long as you don't have to reduce it, you could do incredibly, incredibly well without any share capital growth. And if you get a tailwind of some kind of big boost in the annuity side of the business on the back of that, which I think you potentially could, I I think you could make an argument, but for me, it's just too difficult.
Fine. What about Deliveroo then?
So Deliveroo is a business we have covered before. I think we covered it when it originally IPO'd, and I don't think we came back to it because it didn't make any money. And also it seems to be wanting to take the most unprofitable side of a lot of takeaway businesses off their hands. So a couple of years have now gone by, so I thought we would revisit it as one of the few kind of techie stocks listed on the FTSE. So Deliveroo have come out with their full year results, and orders were up 2% to 296 million. The gross transaction value per order was up 3% to £25.10p. The gross transaction value overall was up 5% to 7.4 billion. Revenue was up 2% to 2.07 billion. And revenue as a percentage of gross transaction value was down from 28.7% to 27.9%. Gross profit was up 6% to 766.9 million. And the gross profit margin as a percentage of gross transaction value was flat at 10.3%. Considering we started this by saying it was a tech business, 10.3% gross margin is not a good start. Adjusted EBITDA up 52% to 129.6 million, and as a percentage of gross transaction value, the adjusted EBITDA is up 50 basis points to 1.7%. Again, I dread to think what the actual operating profit is if they've adjusted it and only managed to get it to 1.7%. Again, that's not great. Profit for the year has gone from a £31.8 million loss to a £2.9 million profit, and free cash flow has gone from a £38 million outflow to an £85 million inflow. The net cash position is down 1%. They have highlighted that they've seen positive signs of consumer engagement, with average order frequency increased across every annual cohort at a group level, and retention improved through the year, supported by progress on their consumer value proposition, despite continued macroeconomic uncertainty in major markets. They've said the free cash flow of 86 million includes a 48 million outflow for cash exceptionals and a 77 million inflow of working capital, primarily due to the timing of the year end, while excluding 27 million of interest income. So I would say that if you adjust the free cash flow to exclude the inflow of working capital, which you arguably should, because that's presumably going to go back out again, the free cash flow is not actually looking that great. So the net cash position, I mean, this will be boosted as well by that working capital inflow that we've just mentioned, but they've said that there's 30 million EBT share purchase completed and 90 million of the £150 million share buyback completed in 2024. I suppose that is quite good, actually. For the 2025 outlook, they've said gross transaction value growth is anticipated to be high single-digit percentage in constant currency. The adjusted EBITDA is expected to be in the range of 170 to 190 million. So that 170 to 190 million would be up from 130 million. So that's pretty decent. And in the medium term, they said gross transaction value growth, they're targeting mid-teens percentage growth per annum in constant currency, and profitability, they want the adjusted EBITDA margin to be 4% plus in the medium term, with margin improvements accelerating from 2026. They operate across 10 markets, which include Belgium, France, Hong Kong, Italy, Ireland, Kuwait, Qatar, Singapore, the UAE, and the UK. I wouldn't say any of these markets hugely encouraging, really, apart from, I guess, the UK. I don't really know how big they are in some of the other markets, but a lot of them are just kind of small, random Middle Eastern states where I can't imagine the market's huge. They've said that improvement in growth was driven by continued strength in the UAE and Italy and stabilisation in France, which was a drag on growth in the prior year. And they've said, as announced on the 10th of March, they've decided to exit the Hong Kong operations through a sale of assets to Food Panda and the closure of others. Hong Kong represented 5% of the group transaction value in 2024 and had a 5 percentage point negative impact on international gross transaction value for the year. And they said the monthly active customers averaged 7.1 million across 2024 overall, which was in line with 2023. And the year-on-year declines they experienced in 2023 have shown signs of stabilisation. I would mention as well that in Europe, the European online food delivery market is expected to grow at a compound annual growth rate of 7.7% from 2025 to 2030. However, they're only operating in a few European markets. And even then, they are just so competitive. You've got Uber Eats, whatever other local ones there are. I don't know if I'd really back them to go and take a market leading position in any of them. And you could have a lot of market share and still lose money in a lot of these markets, as shown in Hong Kong. In terms of valuation, the business trades at a price to sales ratio of 0.95. We don't have any earnings, and they trade at 2.57 times gross profit. It's about 2.5 times gross profit. The gross profit margin is about 10%, and they want to get to 4% adjusted EBITDA, which we will assume is going to equal operating profit, although it's unlikely to be the case because they would probably use the word operating profit instead. But if it was 4%, it would go up to 6.2 times operating profit, I think. Well, adjusted EBITDA, if it was to hit the 4% target, which is actually fairly cheap. I think the issue is the growth's quite stodgy. It doesn't seem to make a huge amount of money. I think that gross margin is incredibly low for what it's doing, and that just, I think, has risk written all over it. You've got increases to the minimum wage as well, which will impact the drivers. The fact that it's only in 10 markets kind of suggests that internationally it's not doing overly well. It's going to be 9 after Hong Kong now that that's gone. I think if it had market leading positions in some of these markets, it would be bragging about it. So the fact that it's not really mentioning it suggests to me the international is not doing amazingly well. Even if it is, I think you probably need to be market leader to have a chance of making decent money, because it is just a race to the bottom. People will just compete on price. There is no brand loyalty. So if Uber Eats is cheaper, people will just use that. So I think it's a very, very tough business. You can't really value it properly. I think the 4% target is actually probably quite ambitious based on what we've seen. So yeah, I don't think in the couple of years since we last covered it, anything's fundamentally changed, and I still wouldn't touch it with a barge pole. What about you, John?
Incredibly competitive market. It is commoditized and a race to the bottom. I don't like the industry, very low margin. And the other thing is, when its biggest market is the UK, as you say, with UK regulation, minimum wage, and the pressure that's going to come on it from that perspective in a regulatory sense, is huge. So I think it's unattractive from all ends, regardless of how potentially cheap it may look. I just wouldn't touch it with a barge pole.
No, and I think even if they hit the figures they're talking about, which I don't think they do, and I think the fact it's on such a low valuation compared to those medium-term figures suggests that the market doesn't think it's hugely likely either. Even then, I'm not even sure I'd still want it, given the industry. I know we've described it as tech, but I guess it's a nice app, but at the core, it's a delivery business, and what it's delivering is just not that profitable.
Absolutely, completely agree. And you see that in the share price, how much it's fallen since the IPO.
Okay then, so of the 6 businesses we've covered this week, Persimmon, Dominos, Berkeley Group, Supermarket Income REIT, Legal in General, and Deliveroo, which do you like the most and which do you like the least?
It's a tough one actually. I'd probably say Persimmon, but close second would be Supermarket Income REIT. And the one I like least, that's easy, that's Deliveroo.
So my favourite would be Supermarket Income REIT, which is good because I own it. I think second favourite would probably be Dominos. I do like Dominos a lot. Least favourite, again, incredibly easy, just Deliveroo, absolute no-brainer.
Okay. Fantastic. Well, thank you very much for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.